Here is something worth understanding before this episode goes anywhere specific. Large institutions cannot verify reality. They can only verify documentation. This sounds like a technical distinction, the kind of fine print that lives between the lines of a policy manual and matters to almost nobody. It is not. It is the operating principle behind some of the most consequential differences in how people are treated by the systems they spend their lives inside. Banking systems, insurance systems, government agencies, social benefit programs, licensing boards, lending institutions. Any system large enough to receive claims from millions of people, and small enough in terms of resources, to be genuinely unable to examine all of them. When an institution the size of a government agency or a national insurer receives a claim from you, a claim that something happened, that you qualify for something, that you are who you say you are, that the thing you're describing is real, it faces a choice that has nothing to do with whether you're telling the truth. It faces a resource constraint. It has to decide whether to verify your claim, and if so, how deeply, and at what cost, against what volume of other identical decisions it is simultaneously making about other people. And that decision about how deeply to look and at whose claim is not random. It follows a logic. The logic is nearly always the same. Verify the cases you can close cheaply. Trust the cases that are expensive to challenge. This is not corruption. It is arithmetic. But the arithmetic produces outcomes that fall on different people in very different ways. What follows is the clearest documented example of that principle currently available. David has been driving a truck for 23 years. Not for a company, for himself. He owns 2 trucks, runs his own contracts, pays his own fuel, handles his own scheduling, files his own quarterly taxes, and has done all of this without incident across 2 decades of independent work. He is not wealthy by any standard. He is not struggling by any standard. He is the version of the American working middle class that does not appear in news coverage very often, organized, self-sufficient, invisible in the good sense of the word, not making problems for anyone. His taxes are more complicated than a W-2 employee's because independent work always is. He has mileage deductions, equipment depreciation, maintenance expenses, a portion of his phone. He has a small home office. He had a complicated year 3 years ago when one of his trucks needed an engine, and he had to take a short-term loan against a piece of equipment to cover it. He keeps records of all of this. They are not in a sophisticated accounting system. They are in folders, in a filing cabinet, organized by year, the way someone who has been doing something alone for a long time develops a system that works for him even if it would look improvised to anyone else. He uses a tax preparer, not a CPA, not an enrolled agent, a local tax preparer who handles several hundred returns a year, mostly for people like David, self-employed, small business, moderately complex, needing someone who knows the forms but is not going to charge what a CPA charges. In late February of the year, David turned 57. He received a letter from the IRS. The letter was a CP 2000 notice. It was asking him to substantiate several deductions on his Schedule C from the prior year. The home office deduction, a portion of his truck maintenance, the loan interest he'd claimed against the equipment purchase. The letter gave him a specific number, the amount of additional tax the IRS had calculated he might owe if the deductions were disallowed. The letter gave him a deadline, 60 days. He read it carefully, the way someone reads something when they're not sure if they should be alarmed. He set it down. He picked it up again. He called the phone number on the letter. He was on hold for 54 minutes before he reached someone who explained in the same calm, scripted way these things are always explained, what documentation he would need to provide. Business mileage logs, maintenance receipts, documentation of the home office square footage as a percentage of the home's total square footage, a copy of the loan agreement, bank statements showing the loan payments, a letter from a licensed professional attesting to the legitimacy of the home office claim. He had some of this. The loan agreement was in the file cabinet. He had maintenance receipts, most of them. His mileage log was in the format he'd been using for years, a notebook, entries in ink dated with starting and ending odometer readings and the purpose of each trip. He did not know, going into this, whether the notebook would be acceptable or whether the IRS required a specific form. He spent the better part of 3 weeks pulling documents together. He was still driving during those 3 weeks because he had contracts and deadlines of his own, and the trucks don't stop because the IRS has questions. He submitted what he had. He sent the loan agreement, the bank statements, a year's worth of maintenance receipts, a copy of his lease showing his square footage, and a hand-drawn floor plan with the home office dimensions measured and labeled. He included a letter he wrote himself explaining the business purpose of each deduction, in plain terms, the way someone explains something they know to be true. He did not include a letter from a licensed professional. He hadn't understood that requirement clearly enough on the first call, and by the time he'd submitted everything, the 60-day window was nearly closed. 4 months later, the home office deduction was partially disallowed. There's a man named Richard who prepares tax returns for a living. He is not David's preparer. He is a CPA with 31 years of practice, 3 employees, and a client base that includes several independent contractors roughly similar in profile to David, self-employed, moderate complexity. Schedule C. He mentioned, in passing, to a colleague once, that he had not had a client receive a CP 2000 notice in nearly a decade. This is not because his clients are more honest than David. It is not because they claim fewer deductions. Some of them claim more. It is because the documentation behind their returns is prepared at the outset in a format that anticipates what a verification process would require. When Richard prepares a Schedule C, the mileage log has already been converted into a compliant format. The home office measurement has already been calculated the way the IRS calculates it. The maintenance receipts have already been organized in the way an examiner would need to see them. The return is filed knowing that if anyone looks at it, everything needed to answer the questions is already in place. The return itself looks nearly identical to David's. The deductions are similar. The business structure is similar. The difference is not in what happened. It is in how what happened was prepared to be verified. Richard's clients are not less likely to be selected for review because they're wealthier, though some of them are. They are less likely to produce a compliance gap when reviewed, which means they are less likely to generate the kind of discrepancy that triggers a second look. And if they are reviewed, the documentation that arrives in response to a notice arrives complete, formatted correctly, submitted within the window, through a channel Richard has used before. David's documentation was real. It was accurate. It described things that had actually happened. The IRS could not verify it to the standard the process required. The gap between those two statements is the entire mechanism. Let's look at what that mechanism is, because it matters far beyond this specific situation, and far beyond taxes. When a large institution needs to verify a large number of claims, any claims, not just tax claims, it builds a system. The system has to be efficient. It cannot spend unlimited time on any individual case. It cannot assign a team of investigators to every person who files a form claiming something. It needs to process volume, close cases, and move on. That means it develops criteria for what counts as verified, not criteria for what is true, criteria for what can be confirmed through the evidence the institution can check in the time it has available. The criteria are not arbitrary. They reflect what kinds of documentation are consistent, standardized, legible to the system, and checkable without requiring someone to make a judgment call about whether they believe the person. This produces something specific. The institution starts treating documentation as a proxy for truth. If you have the right documentation, in the right format, submitted in the right way, within the right window, the institution treats what you're claiming as verified. If you don't have those things, or you have them in the wrong format, or you submit them late, or the format is unusual in a way the system doesn't process cleanly, the institution treats the claim as unverifiable, which in practice often means treating it as incorrect. The thing being claimed may be entirely true in both cases. The documentation is what made it different. David's mileage notebook was accurate. Every entry was dated. Every trip was real. Every odometer reading was correct. None of that is in question. What the system encountered was a format it was not built to process as verification. The notebook was evidence. It was not, in the system's terms, documentation. Those are not the same thing, and the difference between them is not intuitive until you've been on the wrong side of it. This is the documentation gap. It is the distance between what actually happened and what an institution can confirm actually happened. It runs everywhere that verification depends on paperwork, records, format requirements, deadlines, and the administrative capacity of the person being asked to prove something. In the specific context of the IRS, this gap has a documented shape. The IRS processes more than 260 million tax returns annually. It audits a fraction of those returns, in recent years, roughly 2 to 3 out of every 1,000. The selection of which returns to examine involves an algorithmic scoring system that flags returns likely to contain errors. But the selection is not purely about the probability of error. It also reflects the cost of examining the case. Certain categories of returns can be examined cheaply through correspondence, by mail with a letter without an agent ever meeting the filer in person. Self-employed taxpayers with moderate incomes, claiming standard deductions for independent work, fall frequently into this category. Their returns can be flagged, a letter sent, documentation requested, and a determination made all through correspondence at relatively low cost per case. Other categories of returns require expensive examination, extended field work, experienced examiners, teams of professionals on the filer's side, and teams of agents on the IRS's side, months of review, negotiations. Returns at the highest income levels, with complex structures, partnerships, corporate holdings, are expensive to examine, not because the IRS chooses not to examine them. It does, but because the examination requires significant resources and produces significant counterpressure. GAO data from a 2022 report documented this pattern in plain terms. IRS officials explained that certain correspondence audits require relatively few resources, and that these audits produced higher amounts of recommended additional tax per audit hour than almost any other audit type except those of the highest income filers. The system, in other words, knows what it costs to audit different categories of filers. That knowledge shapes who gets audited. David, on the Thursday he received his CP 2000 notice, did not know any of this. He knew he had filed correctly. He knew the deductions were real. He did not know that the category his return fell into, self-employed, moderate income, Schedule C deductions, was a category the system could examine cheaply. He thought the letter had arrived because something was wrong. The letter had arrived because his case was inexpensive to open. David's return was in the category that costs relatively little to examine. This is not a statement about David. It is a statement about the arithmetic that runs underneath audit selection, an arithmetic that IRS officials have described in government reports as part of how the system manages its resources. Now here is what makes this worth understanding beyond the IRS. The documentation gap is not a tax mechanism. The IRS is simply the institution where it is most clearly documented, because the IRS is required by law to produce data about its own practices, and that data is published in GAO reports, taxpayer advocate reports, and congressional testimony. Most institutions are not required to explain their verification logic publicly. The IRS is, which makes it the most transparent window available into a mechanism that operates nearly everywhere. Consider what happens when someone applies for Social Security disability benefits. The system receives millions of applications. It approves some and denies others. The appeals process is long. The documentation requirements are specific, and the outcomes vary significantly based on whether the applicant has representation, an attorney or advocate who knows what the system requires to verify a claim and submits documentation in that format. Applications with representation are approved at higher rates than applications without it, not because represented applicants are sicker. Because represented applicants submit documentation the system can more easily verify. Consider what happens when someone appeals a property tax assessment. The appeal process exists. Most people who could challenge their assessment don't. Among those who do, the outcomes are better for people who arrive with a licensed appraiser's formal report than for people who arrive with their own analysis of comparable sales, even if both analyses describe the same reality. The system processes the formal report in a format it recognizes. It treats the informal analysis as unverifiable. Consider what happens when someone applies for a business loan at a community bank versus what happens when an established business with a professional lending relationship applies for the same size loan. Both are requesting the same thing. The documentation behind one arrives complete, formatted, anticipating the questions the underwriter will ask. The documentation behind the other arrives in whatever format the applicant was able to produce. The institution evaluates what it can verify. This is not a conspiracy. There is no room in this explanation for a conspiracy, because the mechanism does not require any individual to intend a particular outcome. It requires only that institutions, under resource constraint, process large volumes of claims by developing verification criteria, and that those criteria, operating consistently across millions of decisions, produce a pattern that favors the people who already know what the criteria are. Back to David. On a Thursday afternoon 4 months after he sent his documents, he received a second letter. The home office deduction had been partially disallowed. The additional tax owed was less than he'd feared from the first notice, but it was real money, and the reasoning in the letter, the phrase, documentation provided was insufficient to substantiate the claimed deduction, did not feel to him like an accurate description of what had happened. What had happened was that he had measured his home office. He had calculated it correctly. He had occupied it, used it exclusively for business, done everything the rule required, and had described that accurately in his filing and in the documents he sent. The IRS's standard for substantiating a home office deduction is specific, a particular form, completed in a particular way, with measurements verified in a particular format. David had provided the measurements. He had not provided the form. The form exists. His preparer hadn't included it. Neither David nor his preparer knew, going into this, that the form was the part the system needed. He paid the additional tax. He did not appeal. Not because the appeal was hopeless, not because the original deduction was wrong. He didn't appeal because the same letter that told him the deduction was partially disallowed also told him he had 30 days to appeal, and the appeal instructions were 2 paragraphs on the 3rd page written in the administrative language of rights and procedures. And by the time David was reading those paragraphs, he had already spent 3 weeks gathering the first round of documents and 4 months waiting for a determination, and he was tired in the specific way that institutional processes produce in people who are navigating them alone. He paid, he filed, he moved on. There is a specific thing worth naming before this gets too wide. The gap David experienced is not primarily about income. It's about the distance between what actually happened and what the institution could confirm happened. That distance can be closed by anyone who understands what the institution needs to confirm, which is almost never explained in the notice, rarely explained clearly by the preparer, and almost never known to someone encountering a verification process for the first time. The Taxpayer Advocate Service, an independent office inside the IRS, created by Congress specifically to represent taxpayer interests, documented this in its 2023 report to Congress. A significant portion of correspondence audit outcomes that result in additional tax may reflect documentation failure rather than actual noncompliance. The taxpayer was entitled to the deduction. The documentation did not satisfy the verification standard. The system, which cannot know what it cannot verify, treated the gap as an error. There is an entire set of resources that exists precisely for this situation. Enrolled agents, licensed specifically to represent taxpayers before the IRS. Low-income taxpayer clinics in nearly every state, providing free or low-cost representation for qualifying filers. The IRS's own appeals process, available before any court involvement, with outcomes that consistently produce better results for filers who use it than for filers who don't. David did not know these things existed. The letter he received was required to inform him of his right to appeal. It was not required to tell him that free representation was available or that the appeal process had a track record of favorable outcomes for filers with cases like his. That information is contained elsewhere. In publications the notice references but does not reproduce. The system provided David with everything he was legally required to receive. It provided him with almost none of what he needed. Here is the version of this that sits in almost everyone's financial life, whether they've encountered the IRS or not. You interact with large institutions regularly: your bank, your insurer, a government benefit program, a licensing board, a loan underwriter, a property assessor. Any institution large enough to receive claims from a meaningful number of people is, by definition, operating some version of this logic, verifying what it can verify, trusting what is expensive to challenge, closing cases by the standard of documentation rather than by the standard of truth. This does not make any of these institutions dishonest. They are, nearly always, doing exactly what they are designed to do, within the constraints they actually face, using the resources they actually have. The mechanism is not fraud. The mechanism is the predictable output of any large system that has to make a large number of decisions about claims it cannot fully investigate individually. What it means, for anyone navigating one of these systems, is that the question to ask is not what happened, but what can I document in the format this system requires, within the time this system allows. Those are different questions, and the gap between them is exactly the size of the documentation gap. David filed his taxes the following year. He bought a software program that generates the home office form correctly. He kept his mileage log in a format that matches the IRS's standard record-keeping requirements, which he looked up after the first notice arrived, and have been available on the IRS website the entire time. He keeps his maintenance receipts organized by vehicle and by calendar quarter. He has not received a second notice. Not because his taxes changed, not because his deductions changed, because the documentation changed. The reality was the same in both years. The institution's ability to confirm the reality is what's different now. That is the only thing that changed. It was the only thing that ever needed to. What the institution encounters is never the person. It encounters the record the person was able to produce. 3 episodes now. 3 institutions, 3 mechanisms, each one different in its shape but related in its logic. A bank that's sorted by a number you were never shown. An insurance company that's sorted by a process you didn't know you were navigating. A government agency that's sorted by documentation you didn't know you needed to produce. None of them required a villain. None of them required a conspiracy. None of them even required a mistake. They required only that large systems optimize for what large systems always optimize for, closing cases at scale, within resource constraints, by the criteria they can actually apply. The harder question isn't why the systems work this way. Anyone who has spent time inside a large institution knows why: the volume, the constraints, the need for criteria that can be applied consistently across millions of decisions. The harder question is what happens to the person operating inside all 3 of these systems simultaneously, absorbing all 3 of these invisible rules, across a lifetime of financial interactions, without knowing any of them were operating, without knowing what the criteria were, and without ever receiving the explanation that might have changed how they navigated any of it. That question is not about institutions, it's about people. And that's where the next part of this story begins.